Chapter 1, Scope and Objective of Financial Management. Chapter Overview. The Financial Management. In this chapter, we will learn about scope and objectives of financial management, profit maximization vis-a-vis wealth maximization, role and function of Chief Finance Officer, and relationship of financial management with other disciplines of accounting. Introduction. We will like to explain financial management by giving a very simple scenario. For the purpose of starting any new business venture, an entrepreneur goes through the following stages of decision making. Stage 1. Decide which assets, premises, machinery, equipment to buy. Stage 2. Determine what is total investment since assets cost money required for buying assets. Apart from buying assets, the entrepreneur would also need to determine how much cash he would need to run the daily operations, payment for raw materials, salaries, wages, etc. In other words, this is also defined as working capital requirement. And stage 4, the next stage is to decide what all sources does the entrepreneurs need to tap to finance the total investment, assets and working capital. The sources could be share capital, including entrepreneurs borrowed own fund or borrowings from banks or investments from financial institutions, etc. While deciding how much to take from each sources, the entrepreneur would keep in mind the cost of capital for each. As an entrepreneur, he would like to keep the cost of capital low. Thus, financial management is concerned with the efficient acquisition and allocation of funds with an objective to make profits for owners. In other words, focus on of financial management is to address three major financial decisions areas, namely investment, financing, and dividend decision. Any business enterprises requiring money and the three key questions being inquired into: where to get the money from, where to invest the money, and how much to distribute among the shareholders to keep them satisfied. Meaning of financial management. Financial management is that managerial activity which is concerned with planning and controlling of the firm's financial resources. In other words, it is concerned with acquiring, financing, and managing assets to accomplish the overall goal of business enterprises, mainly to maximize the shareholders' wealth. In today's world, where positive cash flow is more important than book profit, financial management can also be defined as planning for the future of business enterprise to ensure a positive cash flow. Some experts also refer to financial management as science of money management. It can be also defined as financial management compromises of forecasting, planning, organizing, directing, coordinating, and controlling of all activities relating to acquisition and application of the financial resources of an undertaking in keeping with its financial objective. Another very elaborate definition given by Philippus is financial management is concerned with the managerial decisions that results in the acquisition and financing of short-term and long-term credits for the firm. As such, it deals with the situation that requires selection of specific assets or combinations of assets, the selection of specific problem of size and growth of an enterprise. The analysis of these decisions is based on the expected inflow of and outflow of funds and their effect of managerial objective. There are two basic aspects of financial management vis-a-vis procurement of fund and an effective use of these funds to achieve business objectives. Aspects of financial management involves procurement of fund and utilization of fund. Procurements of fund. Since funds can be obtained from different sources, therefore their procurement is always considered as a complex problem by business concern. Some of the source for funds for a business enterprise are debentures and bonds, owners fund, angle financing, commercial banks, and venture capital. In a global competitive scenario, it is not enough to demand on the available way of raising finance, but resource mobilization has to be undertaken through innovation way on financial product while may meet the need of investors. We are constantly seeing new and creative source of funds which are helping the modern businesses to grow faster. For example, trading in carbon credit is turning out to be the other source of funding. Funds procured from different sources have different characteristics in terms of risk, cost, and control. The cost of funds should be at the minimum level. For that, a proper balance of risk and control factor must be carried out. Another key consideration in choosing the source of new business finance is to strike a balance between equity and debt to ensure the funding structure suits the business. Let us discuss some of the sources of funds. First, A. Equity. The fund raised by the issue of equity shares are the best from the risk point of view for the firm. Since there is no question of repayment of equity capital except when the firm is under liquidation from the cost point of view. However, equity capital is usually the most expensive source of funds. This is because the dividend expectation of shareholders are normally higher than prevalent interest rate, and also because dividends are an appropriation of profit not allowed as an expenses under the income tax act. Also, the issue of new shares to public may dilute the control of the existing shareholders. Debentures. Debentures as a source of fund are comparatively cheaper than the share because of their tax advantage. The interest the company pays on debenture is free of tax. Unlike a dividend payment, which is made from the tax profits. However, even when times are hard, interest on debenture loan must be paid, whereas dividend need not to be. However, debenture entail a high degree of risk since they have to be repaid as per the terms of agreement. Also, the interest payment has to be made whether or not the company makes the profit. Funding from bank. Commercial banks plays an important role in funding of the business enterprises. Apart from supporting businesses in their routine activities, they play an important role in meeting the long-term and short-term needs of a business enterprise. Different lending services provided by commercial banks are depicted as follows. Lending services, fund-based. First, cash credit, overdraft, term loans, and working capital term, bill purchase discounting. Guarantee non-fund based guarantee and letter of credit. International funding. Funding today is not limited to domestic market. With liberalization and globalization, a business enterprise has options to raise capital from international market also. Foreign direct investment, also known as FDI, and foreign institutional investment, also known as FII, are two major routes for raising funds from foreign sources beside ADR, American Depository Receipt, and Global Depository Receipt, GDR. Obviously, the mechanism of procurement of fund has to be modified in the light of the requirement of foreign investors. Angle financing. Angle financing is a form of an equity financing where an angle finance investor is a wealthy individual who provides capital for startups or expansion in exchange for an ownership equity in the company. Angle investors have idle cash available and are looking for a high rate of return that what is given by traditional investment. Typically, angles as they are known as well invest around 25 to 60% to help a company get started. This source of finance sometimes is the last option for startups which does not qualify for bank funding and are too small for venture capital financing. Effective utilizations of funds. The financial management is also responsible for effective utilizations of funds. He has to point out situations where the funds are being kept idle or where proper use of fund is not being made. All the funds are procured at a certain cost and after entailing a certain amount of risk. If these funds are not utilized in the manner so that they generate an income higher than the cost of procuring them, there is no point in running the business. Hence, it is crucial to employ the funds properly and profitably. Some of the aspects of funds utilization are utilization for fixed asset. The funds are to be invested in the manner so that the company can produce at its optimum level without endangering its financial solvency. For this, the financial manager would be required to possess a sound knowledge of the techniques of capital budget. Capital budgeting is the plan process used to determine whether a firm's long-term investments such as new machinery, replacement machinery, new plant, new product, and research development project would provide the desired return. that is profit. Utilization for working capital. The finance manager must also keep in view the need for the adequate working capital and ensure that while the firm enjoy at optimum level of working capital, they do not keep too much funds blocked in inventories, book debts, cash, etc. Evolution of financial management. Financial management evolved gradually over the past 50 years. The evolution of financial management is divided into three phases. Financial management evolved as a separate field of study at the beginning of the century. The three stages of its evolution are the traditional phase. During this phase, financial management was considered necessary only during occasional events such as takeovers, mergers, expansions, liquidation, etc. Also, when taking financial decisions in organization, the need of outsider investment bankers, people who lend money to the business, and other such people to the business was kept in mind. Traditional phase. During the phase, the day-to-day problems that financial managers faced were given importance. The general problems related to funds analysis, planning and control were given more attention in this phase. The modern phase. Modern phase is still going on. The scope of financial management has greatly increased now. It is important to carry out financial analysis for a company. This analysis helps in decision making. During this phase, many theories have been developed regarding efficient market, capital budgeting, option pricing, valuation, modules, and also in several other important fields in financial management. Finance function, finance decision. Value of a firm will depend on various finance function decision. It can be expressed as V equals to F I F T. The financial function are divided into long-term and short-term functions decision. Long-term finance function decision. Investment decision. These decisions relate to the selection of asset in which funds will be invested by a firm. Funds procured from the different sources have to be invested in various kinds of assets. Long-term funds are used in a project for various fixed assets and also for current assets. The investment of fund in a project has to be made after careful assessment of the various projects through capital budgeting. A part of long-term funds is also to be kept for financing the working capital requirement. Assets management policies are to be laid down regarding various items of current assets. The inventory policy would be determined by the production manager and the finance manager, keeping in view the requirement of production and the further price estimates of raw materials and the availability of funds. Financing decision. These decisions relate to acquiring the optimum finance to meet financial objectives and seeing that fixed and working capital are effectively managed. The financial manager needs to possess a good knowledge of the sources of available funds and their respective costs, and need to ensure that the company has a sound capital structure, that is a proper balance between equity capital and debt. Such managers also need to have a very clear understanding as to the difference between profit and cash flow, bearing in mind that profit is of little avail unless the organization is adequately supported by cash to pay for assets and sustain the working capital. Financing decision also called for a good knowledge of evaluation of risk, that is excessive debt carrying high risk for an organization, equity base of because of the priority rights of the lender. A major area for risk related decision is in overseas trading, where an organization is vulnerable to currency fluctuation, and the manager must be well aware of the various protective procedures such as hedging. It is a strategy designed to minimize, reduce, or cancel out the risk in another investment available to him. For example, someone who has a shop takes care of the risk of the goods being destroyed by fire by hedging it via a fire insurance contract. Dividend decisions. These decisions relate to the determination as to how much and how frequently cash can be paid out of the profit of an organization as income for its owners, shareholders. The owner of any profit making organization looks for reward for his investments in two ways: the growth of the capital investment and the cash paid out as income. For a sole trader, this income would be termed as drawings, and for a limited liability company, the term is dividend. The dividend decision thus has two elements: the amount to be paid out and the amount to be retained to support the growth of the organization. The latter being also a financing decision, the level and regular growth of dividend represent a significant factor in determining a profit-making company's market value, that is, the value placed on its share by the stock market. All three types of decisions are interrelated, the first two pertaining to any kind of organization, while the third relates only to profit making organization. Thus, it can be seen that financial management is of vital importance at every level of business activities, from a sole trader to the large multinational corporations. Short-term finance decision function. Working capital management. Generally, short-term decisions are reduced to management of current assets and current liabilities, that is working capital management. Importance of financial management. Importance of financial management cannot be overemphasized. It is indeed the key to success business operation. Without proper administration of finance, no business enterprise can reach at its full potential for growth and success. Money is to an enterprise what oil is to an engine. Financial management is all about planning investment, funding the investment, monitoring expenses against budget, and managing gains from the investment. Financial management means management of all matters related to the organization's finance. The best way to demonstrate the importance of good financial management is describe some of the tasks that it involves. Take care not to overinvest in fixed capital assets, balance cash outflow with cash inflows, ensuring that there is a sufficient level of short-term working capital, settling sales revenue target that will deliver growth, increasing gross profit by settling the correct price for products or services, and controlling the level of general and administrative expenses by finding more cost efficient ways of running the day to day business operation, and tax planning that will minimize the taxes a business has to pay. Scope of financial management. As an integral part of the overall management, financial management is mainly concerned with acquisition and use of funds by an organization. Based on financial management, Guru Isa Solomon's concept of financial management, following aspects are taken up in detail under the study of financial management. First, determination of size of enterprises and determination of rate of growth. Determining the composition of assets of the enterprises, determining the mix of enterprises financing, that is consideration of level of debt to equity, etc., and analyzes planning and control of financial affairs of enterprises. Role of financial controller. The role of financial controller has undergone changes over the years. Until the middle of this century, its scope was limited to procurement of fund under major events in the life of the enterprise, such as promotion, expansion, merger, etc. In the modern time, the role of financial controller includes, besides procurement of fund, the three different kinds of decisions as well, namely investment, financing, and dividend. All the three types of decision would be dealt in detail during the course of this chapter. The given figure depict the overview of the role and function of financial control. It also gives the interrelation between the market value, the financial decisions, and risk returns trade of the financial controller. In a bid to maximize shareholders' wealth, should strive the maximum return in relation to the given risk. He should seek courses of actions that avoid unnecessary risk. To ensure maximum return, funding flow in and out of the firm should be constantly monitored to assure that they are safeguarded and properly utilized. Financial controller, maximization of share value, financial decision, investment decision, dividend decision, trade-off, return and risk. Objectives of financial management. Efficient financial management requires the existence of some objective or goal because judgment as to whether or not a financial decision is efficient must be made in the light of some objective. Although various objectives are possible, but we assume two objectives of financial management for elaborate decisions discussions. These are profit maximization and wealth value maximization. Profit maximization. It has traditionally been argued that the primary objective of a company is to earn profit. Hence, the objective of financial management is also profit maximization. This implies that the finance manager has to make his decision in a manner so that the profit of the concern are maximized. Each alternative, therefore, is to be seen as to whether or not it gives maximum profit. However, profit maximization cannot be sole objective of a company. It is at best a limited objective. If profit is given undue importance, a number of problems can arise. Some of these have been discussed below. The term profit is vague. It does not clarify what exactly it means. It conveys a different meaning to different people. For example, profit may be in short term or long term period. If it may be total profit or rate of profit, etc. Profit maximization has to be attempted with the realization of risk involved. There is a direct relationship between risk and profit. Many risky propositions yield higher profit. Higher the risk, higher is the possibility of profit. If profit maximization is the only goal, the risk factor is altogether ignored. This implies that the financial management will accept risky proposals also if they give higher profits. In practice, however, risk is very important consideration and has to be balanced with the profit objective. Profit maximization as an objective does not take into account the time pattern of return. Proposal A may give a high amount of profits as compared to proposal B. Yet, if the return of proposal A being to flow, say 10 years later, proposal B may be referred, which may have low overall profit, but the return flow is more yearly and quick. Profit maximization as an objective is too narrow. It fails to take into account the social consideration as also the obligation to various interests of workers, consumers, society, as well as ethical trade practices. If these factors are ignored, a company cannot survive for long. Profit maximization at the cost of social and moral obligation is a short sighted policy. Wealth maximization, value creation. We will first like to define what is wealth maximization model. Shareholders' wealth are the result of cost benefit analysis adjusted with their time and risk, that is time value of money. So wealth equals to present value of benefit minus present value of costs. It is important that the benefit mean measured by the finance manager are in terms of cash flow. Finance managers should emphasize on cash flow for investment or financial decision, not on accounting profit. The shareholder value maximization model holds that the primary goal of the firm is to maximize the market value and implies that business decisions uh, should seek to increase the net present value of the economic profit of the firm. So, for measuring and maximizing shareholders' wealth, finance managers should follow cash flow approach, not accounting approach, cost benefit analysis, and application of time value of money. How do we measure the value wealth of a firm? According to Wayne Horn, value of a firm is represented by the market price of the company's common stock. The market price of a firm's stock represents the focal judgment of all market participants as to what the value of the particular firm is. It takes into account present and prospective further earns per share, the timing and risk of these earnings, the dividend policy of the firm, and many other factors that bears upon the market prices of the stock. The market prices serve as a performance index or report card of the firm's progress. It indicates how well management is doing on behalf of stakeholders. Stockholders hire managers to run their firm for them because stockholders have absolute power to hire and fire managers. Manager sets aside their interest and maximizes stock price because market are efficient. Stockholders' wealth is maximized because lenders are fully protected from shareholders' action. Firm value is maximized because there are no costs created for society, and societal wealth is maximized. Value of firm equals to number of shares into market price of shares. Way why wealth maximization works. Before we answer this question, it is important to understand and know what other goals a business enterprise may have. Some of the other goals a business enterprise may follow are achieving a higher growth rate, attaining a large market share, gaining leadership in the market in terms of product and technology, promoting employee welfare, increasing customer satisfaction, improving community life, supporting educations and researches, solving social problems. Though the above goals are important, but the primary goal remains to be wealth maximization as it is critical for the very existence of the business enterprise. If this goal is not met, public institutions would lose confidence in the enterprise and will not invest further in the growth of the organization. If the growth of the organization is restricted, then the other goals like community welfare will not get fulfilled. Conflicts in profit versus value maximization principle. In any company, the management is the decision taking authority. As a normal tendency, the management may pursue its own personal goals. But in an organization where there is a significant outside participation, the management may not be able to exclusively pursue its personal goals due to the constant supervision of various stakeholders of company employees, uh, creditors, customers, government, and etc. Every entity associates with the company will evaluate the performance of management from the fulfillment of its own objective. The survival of the management will be threatened if the objective of any of the entities remain unfulfilled. The wealth maximization objective is generally in accordance with the interests of the various groups such as owners, employees, creditors, and societies, and thus it may be consistent with the management objective of survival. Owing to limitations in profit maximization in today's real world situation, which is uncertain and multi period in nature, wealth maximization is a better objective where the time period is short and degree of uncertainty is not great. Wealth maximization and profit maximization amount to essentially the same. The table below highlights some of the advantages and disadvantages of both profit maximization and maximization. Profit maximization, large amount of profit, objective, earns to easy to calculate profits, easy to determine the link between the financial decisions and profits. Disadvantages, emphasizes the short-term gains, ignores risk or uncertainty, ignores the time of returns, requires immediate resources. Shareholders' wealth maximization, highest market value of shares, emphasize advantages, emphasizes the long-term gains, recognizes risk and uncertainty, recognizes the timing of returns, considers a shareholder's returns. Disadvantages, offers no clear relationship between financial decisions and share price, can lead to management anxiety and frustration. Example, profit maximization can be achieved in short term at the expense of the long term goal, that is, wealth maximization. For example, a costly investment may experience loss in the short term but yield substantial profit in the long term. Also, a firm that want to show a short term profit may, for example, postpone major repairs of replacement altogether, although such postpone is likely to hurt its long term profitability. Following illustration can be taken to understand why wealth maximization is preferred objective than profit maximization. Role of finance executive. Modern finance management has come to a long way from the traditional corporate finance. As the economy is open up and global resources are being tapped, the opportunities available to finance managers virtually have no limits. A new era has urged during the recent years for chief finance officer in different organizations to finance executive is known in different name. However, their roles and functions are similar. His role assumes significance in the present day context of liberalization, deregulation, and globalization. Changing role of the finance executive. Today's CFO team is expected to add value well beyond the traditional role of cost management, control, and acting as the conscience of the organization. These roles are changing enough, but today's CFO is expected to work in collaboration by serving as the integration hub for key business processes, as a catalyst for change, including business transformation, and as a consultant or trusted business advisor in helping the create sustainable growth. Jeff Thompson, IMA President and CEO. To sum it up, the finance executive of an organization plays an important role in the company's goal, policies, and finance success. Its responsibilities include financial analysis and planning, determining the proper amount of funds to employ in the firm, that is, designating the size of firm and its rate of growth, investment decisions, the efficient allocation of funds to specific assets, financing and capital structure decisions, raising funds on favorable terms as possible, that is, determining the compositions of liability, management of financial resources such as working capital, and risk management, protecting assets. The figure below shows how the finance function in a large organization may be organized. Role of finance executive in today's world vis-a-vis in the past. Today, the role of chief financial officer or CFO is no longer confined to accounting, financial reporting, and risk management. It's about being a strategic business partner of the chief executive officer or CEO. Some of the key differences that highlights the changing role of a CFO are as follows. What a CFO used to do: budgeting, forecasting, accounting, treasury, preparing internal financial report for management, preparing quarterly annual filing for investors, tax filing, tracking accounts payable and accounts receivable, travels and entertainment expense management. What a CFO now does: budgeting, forecasting, managing M&As, profitability analysis, price analysis, decision about outsourcing, overseeing IT function, overseeing the HR function, strategic planning, regulatory compliances, and risk management. Financial distress and insolvency. There are various factors like price of the product service, demand, price of input, that is raw material, labor, etc., which is to be managed by an organization on a continuous basis. Proportion of debt also need to be managed by an organization very delicately. Higher debt require higher interest, and if the cash inflow is not sufficient, then it will put lot of pressure to the organization. Both short-term and long-term creditors will put stress to the firm. If all the above factors are not well managed by the firm, it can create situation known as distress. So financial distress is a position where cash inflow of a firm are inadequate to meet all its current obligation. Now, if distress continues for a long period of time, firm may have to sell its asset, even many times at a lower price. Further, when revenue is inadequate to revive the situation, firm will not be able to meet its obligation and become insolvent. So, insolvency basically means inability of a firm to repay various debts and is a result of continuous financial distress. Relationships of financial management with related disciplines. As an integrated part of the overall management, financial management is not a totally independent area. It draws heavily on related disciplines and areas of study, namely economics, accounting, production, marketing, and quantitative methods. Even though these disciplines are interrelated, there are key differences among them. Some of the relationships are being discussed below. Financial management and accounting. The relation between financial management and accounting are closely related to the extent that accounting is an important input in financial decision making. In other words, accounting is a near necessary input into financial management function. Financial accounting generates information relating to operations of organization. The outcome of accounting is the financial statements such as balance sheet, income statement, and the statement of change in the financial position. The information contained in these statements and reports helps the financial manager in gauging the past performance and further direction of the organization. Though financial management and accounting are closely related, still they differ in the treatment of funds and also with regards to decision making. Some of the differences are treatment of funds. In accounting, the measurement of fund is based on the accrual principle, that is, revenue is recognized at the point of sale and not when the cash collected, and expenses are recognized when they are incurred rather than when actually paid. The accrued basis accounting data do not reflect fully the financial conditions of the organization. An organization which has earned profit may said to be profitable in accounting sense, but it may not be able to meet its current obligation due to shortage of liquidity as a result of, say, uncollectible receivables. Such an organization will not survive regardless of its level of profit, whereas the treatment of fund in financial management is based on cash flows. The revenues are recognized only when cash is actually received and expenses are recognized on actual payments. This is so because the financial manager is concerned with the maintenance of solvency and of the organization by providing the cash flows necessary to satisfy its obligation and acquiring and financing the assets needed to achieve the goals of organization. Thus, cash flow based returns helps financial manager to avoid insolvency and achieve desired financial goal. Decision making. The purpose of accounting is to collect and present financial data of the past, present, and future operations of the organization. The financial manager uses this data for financial decision making. It is not that the financial manager cannot collect data or accountant cannot make decision, but the chief focus of an accountant is to collect data and present the data, while the financial manager's primary responsibility related to financial planning, controlling, and decision making. Thus, in a way, it can be stated that financial management begins where accounting ends. Financial management and other disciplines. For its day-to-day decision-making process, financial management also draws on other related disciplines such as marketing, production, and quantitative methods, apart from accounting. For instance, financial managers should consider the impact of new product development and promotion plans are made in marketing media since their plans will require capital outlays and have an impact on the projected cash flows. Likewise, changes in the production process may require capital expenditure, which the financial manager must evaluate and finance. Finally, the tool and technique of analysis developed in the quantitative method discipline are helpful in analyzing complex financial management problems. The above figure depicts the relationship between financial management and the supportive discipline. The marketing, production, and quantitative methods are thus only indirectly related to day to day decisions making by financial management and are supportive in nature, while accounting is the primary discipline on which the financial manager draws considerably. Even economics can also be considered as one of the major disciplines which helps the financial manager to gain knowledge of what goes on in the world outside in the business. Agency problem and agency cost. Though in a sole proprietorship firm, partnership, etc., owners participating in management, but in corporate, owners are not active in management. So there is a separation between owner, shareholder, and managers. In theory, managers should act in the best interest of shareholders. However, in reality, managers may try to maximize their individual goals like salaries, perks, etc. So there is a principal agent relationship between managers and owners, which is also known as agency problem. In a nutshell, agency problem is the chance that manager may place personal goals ahead of the goals of owner. Agency problem leads to agency cost. Agency cost is the additional cost borne by the shareholders to monitor the manager and control their behavior so as to maximize shareholders' wealth. Generally, agency costs are of four types. First, monitoring, bonding, opportunity, and structuring. Addressing the agency problem. The agency problem arises if managers' interests are not aligned to the interest of the debt lenders and equity investors. The agency problem of debt lenders would be addressed by imposing negative covenants, that is, a manager cannot borrow beyond a point. This is one of the most important concepts of modern day finance, and the application of this would be applied in the credit risk management of banks, fundraising, valuing distressed company. Agency problem between the managers and shareholders can be addressed if the interests of managers are aligned to the interest of shareholders. It is easier said than done. However, following efforts have been made to address these issues. Managerial compensation is linked to the profit of the company to some extent and also with the long term objective of the company. Employees also designed to address the issue with the underlying assumption that maximization of stock price is the objective of the investor. Affecting monitoring can be done. Summary. Financial management is concerned with efficient acquisition and allocation of funds. In the modern time, the financial management includes, beside procurement of funds, the three different kinds of decision as well, namely investing, financing, and dividend. Out of the two objective, profit maximization and wealth maximization in today's real world situation, which is uncertain and multi period in nature, wealth maximization is a better objective. Today, the role of Chief Financial Officer or CFO is no longer confined to accounting, financial reporting, and risk management. It is about being a strategic business partner of the CEO. The relationship between financial management and accounting are closely related to extent that accounting is an important input in financial decision making. Managers may work against the interest of shareholder and try to fulfill their own objective. This is known as agency problem.